When a company undertakes a major construction project, expenses pile up long before the asset generates a single dollar of revenue. If a company expenses the interest on loans used to fund that construction immediately, their current earnings take a massive hit for a project that will only benefit future years. The matching principle dictates that those financing costs should be tied directly to the asset's future economic benefits. Take a look at this three-pillar framework to see how International Accounting Standard 23 solves this. The first pillar defines eligible borrowing costs. This strictly includes the effective interest on your debt, the interest on IFRS 16 lease liabilities, and specific foreign exchange differences that act as an adjustment to interest costs. Not every project qualifies for this treatment. An asset must necessarily take a substantial period of time to get ready for its intended use or sale. We're looking at manufacturing plants, power generation facilities, or agricultural bearer plants. Standard inventory produced in large quantities on a repetitive basis does not count. If an asset naturally requires a long time to build, the cost of the money used to build it is an inherent part of the asset's final value, not an immediate operating expense. Returning to our framework, the third pillar establishes exactly when capitalization begins. You must meet three criteria simultaneously. You are actively incurring expenditures for the asset, you are incurring the borrowing costs, and you are undertaking the active, technical, or physical work necessary to prepare the asset. Capitalization is not an automatic switch that stays on. If there is an extended period where active development of the asset is suspended, capitalization must also pause. During those delays, the holding costs of partially completed assets are recognized immediately as an expense. The timeline of capitalized interest must perfectly mirror the timeline of active economic development on the asset. If work stops, capitalization stops. Let's apply these rules to a concrete timeline. This diagram maps a 12-month construction project starting January 1st. It is funded by a $100,000 specific loan carrying a 10% interest rate. Notice that $50,000 is deployed immediately on day one, and the remaining $50,000 isn't deployed until July 1st. For funds borrowed specifically for an asset, you capitalize the actual interest incurred, but you must deduct any investment income earned by temporarily investing the idle funds. Since that second $50,000 isn't needed for 6 months, the company parks it in a temporary account yielding 4%. The gross interest on the $100,000 loan for the year is $10,000. But we earned $1,000 from the temporary investment over those first 6 months. That $1,000 is deducted directly from the eligible borrowing costs. Then, in October, a non-standard labor strike brings all site development to a complete halt for 1 full month. This triggers the suspension rule. Because active preparation stopped, the interest incurred during October cannot be capitalized. 1 month's worth of interest on the total loan is $833. That amount must be stripped out and routed directly to the income statement as an expense. We take the $10,000 of total interest, subtract the $1,000 of investment income, and subtract the $833 from the suspended month. The final eligible capitalized interest for this specific borrowing is $8,167. Calculating specific borrowing costs is an exercise in precise tracking. You start with the total interest and rigorously strip out strict deductions for investment returns and work stoppages. Now look at what happens on this flowchart on July 1st. The specific loan funds are completely exhausted, forcing the company to draw their next $50,000 expenditure from a central parent company debt pool. Because these general corporate funds are commingled, you cannot tie that $50,000 draw to one single interest rate. You must calculate a weighted average capitalization rate. This general bucket consists of 2 loans. Loan A is $200,000 at 8%, and Loan B is $300,000 at 12%. Pause the video and calculate the weighted average rate for this general pool. Remember the critical rule. You must strictly exclude any borrowings made specifically for the qualifying asset, like the loan we handled in the first half of the year. The total interest for the general pool is $52,000. Divide that by the $500,000 general principal, and you get a weighted average capitalization rate of exactly 10.4. We can consolidate all of this math into our year-end financial reporting. This journal entry breaks it down. We debit the work-in-progress plant asset for our total capitalized interest. That's the specific and general amounts combined, totaling $10,334. We debit cash for the $1,000 of investment income. We debit interest expense for the remaining $50,666. Finally, we credit cash for the total $62,000 of actual interest paid out across all loans. The final phase of IAS 23 dictates when capitalization stops entirely. You must cease capitalizing borrowing costs when substantially all the activities necessary to prepare the asset for its intended use are complete. Take a look at this wireframe of a business park comprising 3 distinct buildings. If Building A is completed and capable of being used independently, capitalization for that specific part ceases immediately. You stop adding interest to Building A's cost, even while Buildings B and C remain under construction. The balance sheet must faithfully reflect the transition from construction to utility. The moment an asset is ready to generate value, its financing costs revert back to being an operational expense. Let's review a final summary graphic of the IAS 23 framework. For specific pools, capitalize the actual interest less investment income. For general pools, apply a weighted average rate to the expenditure over the active time period. Always pause capitalization during work stoppages and cease it completely when the asset is substantially complete. Mastering this standard is about treating the financing of an asset as a dynamic, time-bound component of its physical construction.